Lots of worries about the potential for a recession in the U.S. as well as the globe. We are waiting on the latest numbers in terms of GDP. We know that we're expecting a contraction for the first quarter. Let's find out from the largest bank in America. And that is where we find Brian Moynihan in Davos, Switzerland this week for the World Economic Forum. Bank of America Chairman and CEO Brian Moynihan joining me. Brian, good to see you. What's your take on this? You had a great first quarter, we know, but we want to know if anything has changed in terms of what you told us a few months ago and the strength of the consumer. How would you assess business today?
Well, it's good to see you again, Maria, and you wish you were here in Davos. It's beautiful, as you can see behind me. But let's go back to, at the first quarter, we talked about the strength of the consumer. We talked about the view that we didn't see a recession, et cetera. So our research team currently under Candace Browning-Platt basically has this year about 2.5% growth, next year about 1.5% growth, more or less. They don't really have any quarters that are negative. It slows down. They will say there's a 1 in 3 chance of a recession. That's what they published. The reality is, if it were 2 years ago, they'd say it was a 1 in 5 chance. So they moved up their probabilities, but they really think it's going to be a soft landing and not quite get to recession, although it was slow. Now, you asked me what we see so far. In the month of May, the spending is up double digits from last May, and fairly steady. That's even higher than that because this last May people paid taxes. This May they didn't. The spending on services is way up. You see some of the retail, and you've seen some of those retailers see a little bit more mitigation as people can get out and travel. And so we see that's very good. The money in the customer accounts for the end of the month of April was up over March. Again, very strong, especially in the lower balance accounts. Interesting enough, in the people who get paid and get direct deposits, we're seeing their wages up 8% year over year, especially for median income and down. And then they have lots of borrowing power. So the U.S. consumer is in very good shape. And frankly, that's good news for the Fed, but also makes their job tougher because if you think about wage growth and inflation and wages and the tightness of the labor markets, that's still there. And they've got to slow that down. And that's the tension that will go through the system here over the next 4 to 6 quarters.
And you have been able to grow deposits faster than peers during the pandemic. And you said that the last time in terms of the health of the consumer. They've got money in the bank and money to spend. But you mentioned this tight labor market. You are raising wages, Brian. You announced it this week that the starting wages, $21 to $24 an hour. You've been a leader on this wage issue. How are you doing this while also keeping expenses down?
Well, at the end of the day, we made a commitment several years ago to move up $1 a year in 2020 to 2025. So we've just accelerated that step this year, frankly, because of the market and just moving forward. But importantly, last week, we also sent to our employees under $100,000 basically a 3%, 5%, and 7% raise, depending on the length of service of the company, rewarding longevity, rewarding the career mindset we want. So we have to have the best teammate to serve our customers well. We will reward them well. The reality is our retention stuff. We're hiring 7,000 people in a quarter. We want to get those people to have great careers at our company, and so that's why we're doing this. And so it pays out for the shareholder because, frankly, our expenses, year over year at operating leverage, our expenses this year, we told people we relatively flat to last year, and we still think that's true.
Yeah, I thought that was really interesting that you're expecting expenses to be flat this year, Brian. There's this tech revolution that is certainly happening across the industry, but certainly at B of A. Talk to us about Erica, about Zelle transactions increasing since the pre-pandemic and digital usage also increasing. Give us a sense of the product lines digitally and what you're seeing in terms of customer behaviors changing the way they bank.
Sure.
And doing it digitally.
Yeah. So one of the questions I often get is how can you get this kind of operating leverage and keep expenses flat? Well, that's the investment we made, beginning in 2010, $3.5 billion a year in technology enablement, and also in the business system of rearranging the physical plant. We're high touch and high tech in the branches, so we have both, but the branches are different, redone, remodeled, new branches in cities we weren't. So you're making all this physical plant investments, technology investments in longevity and training employees. But the reality is what's changed a lot during the pandemic is the growth rate of things like Zelle kicked up out of necessity, right? P2P payments, et cetera. But the reality is they've stayed strong. Now, the real reality was through the other parts of the company, we were able to digitize faster than we thought. The private bank, Merrill, the commercial bank. The adoption rates now move from 50s to 80s of customers using the digital tools which we built. which was happening slowly but surely, but just exploded because, frankly, there was no other way to serve the customers. So we have those great financial advisors with a great digital interface with the customers to our company, a great ability to apply and send out research and information through those digital means, sign papers digitally. It's just really good stuff. And so that allows us to keep that expense base flat, but it's 12 years, now 13th year of straight investment of $3.5 billion a year in technology enablement and investing in training and other things that allow us to be more efficient. We run the company with 208,000 people. When I became CEO, we had 280,000 people.
Wow.
And through that time frame, the company's gotten bigger. There's more transactions. There's more complexity. We went from 100 million in cybersecurity to over $1 billion. You know, we had we got 3,000 people in cybersecurity who weren't here then. So think of all the change that's gone on. Yet we were able to get more efficient because every year we spend money to make the company better. Yeah,
and it's helped your operating leverage. Do you expect that operating leverage to be even improving this year and into next year?
That's what we owe the shareholders, and we expect it to happen, yes. And so we hit a low in expenses before the pandemic, and the dynamic changed where we got them from 70 billion down to 54 billion. And the issue was we told people we're going to start to grow. The pandemic came and changed everything. And if you kind of come off that, we're growing at sort of a 1% per year, sort of after the pandemic, is what we said. Sort of the idea is we got to grow revenues at, you know, a little bit faster in the economy, and the economy's a little, you know, got to work through the transition now, but we'll grow fast in the economy. Expenses a couple hundred basis points behind that, and the operating leverage embedded in that produces a nice pre-tax profit, a nice return for our shareholders. But while we're investing in employees and investing in these programs and employee benefits and mental wellness, all because we want our teammates to just be in great shape to serve the clients.
That is just fantastic. It also does something huge for the employee base, just because they've got more confidence in the company and leadership with all of that you're providing. You've also been de-risking for a decade now. Talk to us about how much more de-risking there is. You've taken, what, subprime consumer loans from 20 to 25% down to only 4%. These are mostly multi-products. Where is the risk right now? And do you worry that 5% mortgage rate is pricing people out of the market? We're looking at this housing market that is just soaring in price, mortgage rates going higher. What can you tell us about the mortgage business with 5% mortgage rates?
Well, so a couple things embedded there. We've gotten rid of a lot of that really by 2015-16. So since then, we've just been concentrating on organically growing this company. So there are, I don't know, 50, 60 things that we divested and closed down. So we've been running the business pretty consistent since then. We've been growing commercial loans and consumer loans in our balance sheet and our trading business. We increased by about 20%, 30% to serve the trading customers better. So all that's gone very well. Now, the reality is on the consumer side, the credit quality, in addition to them having money accounts and earning more money and having access to credit, the credit quality is as good as it's ever been. And that's the underwriting that we've been doing for year after year after year. So even, you know, like you said, we don't have a lot of, you know, subprime credit, and usually that's credit that's in transition, but we don't originate it. We're very good at it. Now to the mortgages, simply put, 18%, 20% year-over-year house price growth is not a place we want to be. We remember doing that for a few years, and then you saw what came out of it. So the idea of the Fed slowing down, you know, the new purchase volumes and price appreciation is part of the way they get the economy under control. The good news is that for the 130-odd million American households, there's only 60 to 70 million mortgages. So half the people don't have a mortgage. It's a rent question, which is actually a more serious question for them. The other half of the people have locked in these low rates, and so you've seen originations, refinances fall. You're still seeing some purchase activity. All these people have locked in a heck of a long-term mortgage at 3%. That is very good for them, especially as rates rise and their investments and yields on other things exceed that. So yes, this will slow down the housing market because that's what it's supposed to do.